Hi and welcome to the Market Alert for Wednesday the 31st of March 2021, so the last day of March. Things should get exciting as we go into April after the Easter weekend, as you will see as we go through the Market Alert. So yesterday the main news was that bonds and bullion are being dumped as Bitcoin and the dollar surge, which is what I've already spoken about over the last few weeks. Liquidation demands are trumping rebalancing flows for now, is the sub-headline there. US consumer confidence explodes higher in March, maybe with just a few more $1 trillion of helicopter cash. The Main Street confidence will catch up to Wall Street. Well, we'll see if that happens, given the lofty levels that the market's currently trading at. US home prices are soaring at the fastest pace in 7 years. Don't worry, there's no inflation. And speaking of inflation, we'll come to that in just a moment as well if you want the correct figures. Willfully blind, bulls run as liquidity floods market. That must be the stimmy checks. Reversions, and what we're talking of here is the reversion to the mean, which is halfway through this chart, occur when least expected and always for reasons no one sees coming. And that is absolutely true. That's the way it ends. But until that, they can keep doing what they want. But as it says here, the hazardous detour on the road to recovery, few foresee. As the level of Fed smack and crack needed to maintain the high increases, system fragility increases geometrically, which you can see here on this chart. And I want to find the source for this chart because it's a great one to actually look at there. You can see at a glance where the fiscal and QE amounts actually stand within the annual spending there as well, not spending, printing, sorry, and how it's divided up. So yeah, another interesting news there. And Morgan Stanley CIO says market showing signs of fragility. Too right it is. The Fed's policy of keeping its foot on the accelerator, the chart we've just seen, by printing more QE and fiscal stimulus to boost the economy, has left the market showing signs of fragility. It certainly needs a correction, that's for sure. And here we go again on inflation. Missing prices, half the entire US CPI is based on estimates. So the question is, where can you get the correct figures from? And I'll show you that in just a second. Missing prices make inflation targeting a meaningless policy tool, which is what they've done for years, and they've just kept it down at 1%. But of course, now they want hyperinflation to try and get out of the crap that they've actually painted themselves into. Now, if you want the correct CPI, and based on 1990 and 1980s calculations for the US, then you need to visit shadowstats.com. This is a site created by John Williams, brilliant brain, and you can see here that he's got the correct charts here for 1990. You can see there based on 1990 inflation, and you can see there it's running at 8% through 2010, currently around between 4 and 6%. But when we get to the 1980s, you'll see more of a realistic figure that you're used to in supermarkets, where we're at 10% being as high as around 13% there as well. So if you want the real sort of CPI figures for the US, and that's, let's face it, that's where everything comes from as far as monetary policy, and then is followed by the rest of the world, is Shadow Stats. Right, other news, we've got the implied volatility. This bumped down yesterday as well by 2.46 points. Really odd. What's going on with this at the moment? Something really strange. Does the Dow know something that we don't? Why all of a sudden back down to 15? My only reasoning for this is that the market didn't tank yesterday, but overnight it's looking weaker. So this is likely to change, and again, we're all green at the moment. But as it says in the headlines, there's a lot of fragility around, and also we're seeing that the yield is still in those 170 area after spiking up during Monday's session, off a bit, as you can see there, from the high made during Tuesday's session, which was 177. We got a new high there that we've not seen for some time in the yields there, 177. So are we going to get to 2% when we get back after Easter? Who knows? Yesterday, I'm just going to have a look at, so I'm just going to go back if it will allow me. That's the wrong week. I wanted to have a look. There's probably a way of doing this. Here we go. 30th, apply settings, and then there we go. Yeah, so consumer confidence yesterday spiked the market at 3 p.m. It took a moment or two for the market to react. 109.96.9 before. Today is the only news to watch out for is this one, the ADP farm employment change. And then on Friday, all of this news is going to be released when the stock market is closed. So this will be interesting. I will be around and I'll certainly have a look. It's Good Friday, heading into the Easter weekend. But it will be interesting to see what they actually release, given that they know the market's going to be closed. And they're looking at the moment of creating 652,000 jobs. Although I did see over 1 million in one other news article that was actually forecast. But we'll wait and see. Let's have a look at the Dow, see what this is doing overnight. Market coming off yesterday, sideways at the moment, still above the 5-bar moving average. But what I would be looking at here, they're going to keep the market on the highs going into Easter. They don't want indigestion during the Easter celebrations and munching on their Easter eggs. So close below the 5-bar will take you to 38. But I would be surprised to see if we have a big sell-off. And now I've said that, I'll probably get one. But it would be unusual. They like to keep things on the highs going into any sort of public holiday. But just in case something comes out of the blue, as it said in the news earlier, then these are your fibs to the downside. New all-time high, which was a double top yesterday for the Dow. And in the German DAX, we have a new all-time high in this bar here. So let's get this marked up with this here. So we hit the 15,031, which I spoke about yesterday, going to the R2. I forgot about that. They did that yesterday afternoon. And we've got the 5-bar moving average there as well. Same thing. So let's just draw up from here to here and project down, just in case we get some profit taking. Now we've hit that psychological level that we spoke about and predicted in yesterday's market alert. Here's your range of fibs, just in case we do get a move to the downside. So in the 2-minute chart overnight, we can see that prices moved to the upside initially. We can see this trading up to the 32 level there. That's interesting. Didn't that say 31? Yeah. That's a bit odd. Let me just go back and check that again. Or have I gone too far? No, that's the 31st. That's odd. That's not showing in the daily chart. I did load these charts up at 3:30 a.m. this morning. So let me just reload this, because that doesn't make sense. It may be because the market's been quiet overnight. So let me just redo it. Okay, so I've reloaded. That looks a lot better. So we've opened at the previous day's close. We've moved up. We've gone through the 200 MA. This has become a support. The market is traded up to the BRN, which is the 15,000, and we got as high as 15,013 there overnight. And there's the high that we saw yesterday, 15,031. So prices have made their way down to the DP. There is some weakness around at the moment, quite a cluster of volume here and a spike here to bring the market back. But at the moment, it's sideways, waiting for the futures market to open. So let's just double check the daily chart as well. Let's make sure I've got this right. And yeah, we are 15,031. Let's just double check that just to make sure. We are indeed. Right, so now we know where we are. So I'm just going to look at some other time frames as well, like the 15-minute, just to see where we are. I've started looking at the longer term ones just to hold the trades longer. 15-minute, 5 minutes as well. So there we can get a clearer picture, and it's a lot easier when you're marking up the fib retracements from the upside as well. So from here down to here, just to have a look, see how the market will move back to the upside. I can draw these in and have a look, so I'm not too close to the music in the 2 minute. 2 minutes great to time it, but once you're in the trade, then to step back and look at a longer time frame, and including in this is the 5 minute as well. And there we can see a clearer picture of where we are as well, coming down to the close once more, and then finding support. And again, if you look at the volume, you'll see these clusters a bit more clearly as well, where the market's now just been brought back and then found support here as well, and also overnight as well. When the market opened, you can see this as well. So yeah, things moving quite nicely there. I'm just going to speed through yesterday's DAX as the market moved higher in the pre-market there, and then tried to move higher as well. You can see the selling coming in there, huge red bars, market finding support at the previous day's high, and then moving back to the upside, double top that's put in place there. We just managed to get through, and then you'll see prices drifting all the way back down there to the 78% retracement. You can see them buying in here and then starting to move back to the upside as well. Just speed things up a bit. The yield hit that 177, which we've just looked at as well. This was putting some downside pressure on the DAX. I left this up so I could just see what was going on. And it started to ignore it, with the market coming back there a bit, coming off the high, which is significant as well, which we can see there. And then if we have a look at the afternoon, there's the high. The market again was bought back here just at the 200 MA. Prices moving higher, and it took the afternoon session for the market to go up to the R2, which I've got marked up here. We spoke about this in yesterday's market alert as a target, and then you'll see prices waiting for the consumer news, which came out massively greater than was forecast. You can see a bit of selling coming into the market here. They don't know which direction to take, given that the market had also put in a double top at this point. And then out of the blue, as you see, prices holding at the 20 bar moving average here, and then some buying coming in the following bar. Prices we're getting ready to launch to the upside. Bit of red there, and then all of a sudden, woof, the market moves to the upside and then trades all the way through to put that new all-time high. And you can see the 31 there, where the selling comes in and the market is stopped. So that's your 15,031 with the high volume up thrust there. And then prices drifting back down to the psychological level of 15,000. Now I'm just going to finish off with silver. If I can find it, here we go. Let's have a look at the daily chart. So this also, we're going to the target that was predicted yesterday. We went down to the 23,995, sailed through this, and then the market bounced. But overnight we've got some further weakness. I've been looking at this since 3 a.m. Don't ask me why. Made the fatal mistake of having a look, and then watched this unfold as the market came down to here. Again, you can see a cluster of volume, and just before recording, the market has found support at the previous day's low, and prices are now just starting to move off this. Yeah, we can see that. I'm just checking that it's correct, so we can see this. So now, what I did yesterday, I actually hedged the trade down to the downside on the positions that I've already got. Pulled these off when we got around to 24, and then decided to buy. But the market was showing weakness. It had no interest to actually move high. You can see how prices held at that 24, And in the end, I decided, no, we're going to have more to the downside. And if we look at the daily chart in just a moment, there you can see that we did this, and we've also done this overnight. So now I'm looking to see if this is going to lend support here, and I'm going to look for a pullback to have a bit of a punt to the upside on this. We're due for a bounce in this market. We've had, I don't know how many days now below the 5-bar moving average and the 200 and this. So we are due for a bit of a correction to the upside. It's oversold. I'm not saying that the end game isn't over, because I still think we could go down to 23.50 as the next downside target. All we need is the US dollar to move to the upside, which I've actually put in here now. You can see how the dollar's moving to the upside there. It's not trading at the moment, oddly enough. I don't know why, but that chart isn't updating at this time. But you can see that the next upside target is 93.73, and if we go to this level, then we're likely to trade down to 23.49, put in a nice base for the silver market there. And this goes back to this high here as well. So if I just squeeze this up so you can see this, then you'll get a pretty good idea of what's going on here. And I'm just going to also draw this in here so you've got the double top, because this is where the last selling took place all the way through November. So it's going to be a crucial area for the market. But these two are very important, in particular the 89. If it gets through 89, 94, the yields will have to still increase. That would take you to around 2% on the yield as well, which is interesting, and then brings us down to the 23.49 level, I would imagine, if not a bit lower for the silver market. So I'm not convinced yet we're done when you combine all of the three factors there. So a bit of a bounce today. Like I say, I'm likely to have a bit of a punt on this, or risk 0.5% of the account and see what happens. But I think we're getting close to the bottom being put in on this market at this time. Again, you can see these clusters appearing now as well, which is useful, but not that sort of massive volume in the daily chart. So whether this is just being marked down by the futures traders, who knows? But interesting nonetheless. And like I say, that for me is how I would analyze this, and combining this with obviously the yields and watching the yields move up to that 2% range would be key. And I think then you'd see the Fed come in with its yield curve control system coming into place. I don't think they can afford for this to go above the 2% level. Okay, I know there's a lot in here, but the markets are shut on Friday, so let's cram in as much as we can. And very important information, and it also helps me when I'm actually describing what I'm seeing to actually piece these things together as well, like we've just seen with where the dollar's trading combined with the yield, combined with where silver and also gold, which is a chart that I'm going to start to add in as well, we'll use as well. Okay, that's it for this one. Thanks for watching to the end if you have, and as ever, thanks again, and see you in the next one.